I think now we are set. Good. So I was saying the question is on transfer pricing. The question is on transfer pricing. And division B is the supplier, A is the receiver. So when it comes to revenue, first of all, we have the external. We have the external revenue. External. So as you can see, huko mwisho where we are given the units, you can see the maximum annual production and sales of sets of fittings, including internal and external sales for division B, they are 200,000. They are 200,000. So what is happening is currently they are transferring everything that division A requires. And as you can see, for division A, up there, the maximum annual market demand for ovens in units is 80. So division B will sell 120 externally and 80 internally. So that is how we are going to subdivide them. They will sell 120 to the external market. They sell 80 to the internal market. That is to A. Now, this one that they are selling 180, 120, if you look at the selling price, we are told it is 80 up there. Current external selling price is 80. So multiply 120 by 80 and give me the answer. 120 multiplied by 80, how much is that? Okay. June is asking where 120 is coming from. 120 is coming from here. Ukiangalia hapa kwa your past papers, under division B, if you look at the division B, uteremuke kwa unit, you can see somewhere they have said maximum annual production and sale of sets of fittings, including internal and external sales, 200. Now, if it is 200, if you go up there, slightly before B, where we have the heading for details of A, you can see maximum annual market demand for ovens in units is 80,000. So what is happening currently? Division B is supplying the whole 80 to A, which is an internal customer. It is the other department. Then whatever remains from its production of 200, they sell to the external. So wakisha pair A 80, they are left with 120 from the 200. Is that okay, June? Good. So if it's okay, we proceed. I can see already Ivarin has given me the figure here is 9,600. Then according to the current transfer price, this one is being transferred at 75. So 80 times 75 is equal to what? 80 times 75 is equal to? Yeah, good, good. Is it 600 or 6,000? Yeah, 6,000. We have 6,000. Good. 6,000. Then when we go to division A has received 80, these ones. They process and then they sell it at the external market price. If you look at where we have division A, you can see current selling price for each oven is 450. So multiply this by 450. 80 multiplied by 450, how much are you getting? 80, yes, June, 36,000. We have 36,000. Then for division A, it does not have any internal sales. It does not have internal sales. Now we come to the company. Now I told you anything that is external, it goes to the company. Anything that is external, it goes to the company. So give me the total of 9,600 plus 36,000. 9,600 plus 36,000. What do we have? 45,600. Good. 45,600. Namna hiyo. But whatever is internal, it does not go to the company. So we are not going to feed it there. From there now, we say less variable costs. Or we begin, we put them separately. Less variable costs. Less variable costs. So look at where we have variable costs. Look at where we have variable costs. Now the variable costs, first of all, we start with transfer. Let's start with transfer. The transfer, it is only gotten to be or felt by company A or division A, which is now receiving. So they are going to have 80 times 75, which is 6,000. Remember, I told you that transfer price is a revenue to the supplier and a variable cost to the receiver, but it has no effect on the company. That's why these 6,000 did not come here, and these 6,000 will also not come here because they have no effect on the company. Now, after that, you now bring the own production. So, own production, we have materials. Let's start with the materials. Let's start with the materials for own production. If you go to division B, you can see, first of all, division B is having 200. 200 are the units produced, which we broke into 120 and 80. Those are the ones giving us 200, the maximum production. So this one multiply by 5. Multiply this by 5, that will give us 1,000, if that is okay. Then let's go to division A. When you go to division A, you find it has 80 units times the materials are 200. The cost of materials is 200. So how much is that? 80 times 200 is how much? Yeah, good. 16,000. Now these ones, they are external costs, so they will be felt by the company. So this plus this, we get 17,000. We get 17,000. We proceed and now bring labor. And labor, you also argue the same. You say 200 times. When you go to B, unapata ikona 15. B, it has 15. So 15 times 200 is how much? We have 3,000. Yes. We have 3,000. Then when you go to division B, utasema 80 times 45 times 45. So 80 times 45, what do you have? Yeah, good. That is 600. So when you add this one, you get 6,600. You add those ones, you get 6,600. Let us bring now the fixed costs. We bring the fixed costs. Now, bringing the fixed costs, we will have what they are calling overheads. So the overheads in division B. In division B is 4,400,000. 4,400,000. So hiyo ndio utaweka hapa 4,400,000. Like our figures are in thousands. We needed to have saved that here. They are in thousands. Ukienda kwa division A, when you go to division A, we have 7440. So 7440 plus this one is going to be 11,840. 11,840. So from there now, get the net profit. Get the net profit. Nitafikiria hii ya B. Give me the net profit for B. June is saying 10,160. This one, these revenues minus these costs. Oh, for the company. For the company, June is saying 10,160. Okay. Give me the others. For B, 2960. That should be for A. 2960, yeah. Amisi, we are dealing with question number 3 of May 2019. Question number 3 of May 2019. So hit your 7,200. 7,200. And I told you when you are in transfer pricing, this plus this should be equal to this. Is that so? Are they agreeing? Can you tell me whether they agree? Good, good. I can see the yeses. Hi. So we are through with the part A. Let's go to part B. Let's go to part B. Part B of the question says, head office is considering changing the transfer pricing policy to ensure maximization of companies' profits without demotivating either of the divisional managers. Division A will be given autonomy to buy from external suppliers, and Division B to supply external customers in priority to supplying division A. Now evaluate the maximum profit that could be earned by Kitchen Masters Limited if transfer pricing is optimized. So what will happen is this. You can see division B, it has a capacity of 200 units. And in the question or in the information that we are given there for the units for division B, we are told it is producing 200,000 units, but the maximum annual external demand is 180. And you can see the selling price to the external is 80. So it is higher than the selling price they are getting when they sell internally. Therefore, for every unit they sell internally, they are losing 5 shillings. For every unit they sell internally, they are losing 5 shillings. So given an opportunity like the one outlined here, they would prefer to sell to the external market first. So what will happen? What will happen is that instead of selling 120 to the external, they will sell 180. Then sasa ile imebaki 20 ndio watauzia is what they will sell to division A. Make sure you are following. I'll give you time to write. So 20 is what they sell. But now when you are given such at optimality, because you want to maximize, you don't sell at any other price other than the marginal cost. So division B will come here and check the marginal cost. The marginal cost is 5 plus 15. So instead of selling at 75, they will sell at 20. Maybe I need to put this one here, that it will be 5 plus 15. They will sell at that. So this one will be the new revenue. Now for division B, that will remain. So this one, we will have to change it. First of all, make sure you follow. I'll give you time to write. So this one will have to change because of this one. Then tukikuta hapa, we are going now to factor only. We are going to factor only this 20 times 5 plus 15. That is what we are going to factor. And then, before we capture the fixed cost here, before we capture the fixed cost, we will have what I want to call purchase. We will have what I will call purchase. Then I will bring fixed overheads. Fixed overheads. So purchase will be here for division A. You see they have gotten 20 and they required 80. How many must they buy from the external? Let me see. How many must they now get from the external market? Good, June. Yeah, and I can see 60. Dolcars, good. Yeah. So now that 60, good. That 60 must be bought now. That 60 must be bought. And at what price will they buy the 60? At what price will they buy the 60? I think it has been mentioned at 65. So they will buy, yes, June, at 65. And that question is, we are through with that. We are through with that. So I want you now to copy and give me the new answers. If there is anything you have not followed, please ask. If there is anything you have not followed, yeah, so copy now. Maybe I can give you the figure so that is 180 times 80 is 14,000. 400. This is 20 times 20, that is 400. This is also 400. This is 50,400. So give me the new profits. Yes, June, I can see 6,400, 4660, and then 11,060. Someone else to confirm those results. Yeah, Dorcas says they are okay. Ivarin use 6400, 4660. The 11060 also from Acheng. Yeah. So I think those figures are okay. Those figures are okay. And we can adopt them and proceed. So do we proceed? Do we proceed from there? June says yes. Yeah, good. Jack, Acheng also saying yes. The others, Anne also says yes. Dorcas, okay, so I think even Ruse says yes. So let's discard the last bit. Now discuss the issues of encouraging divisional managers to take decisions in the interest of the company as a whole, where transfer pricing is used. And we provide a reasoned recommendation of a policy that Kitchen Masters Limited should adopt. That question appears as if it is very complicated, but I want just to narrow down to just two issues, which I wanted to write. Number one, there should be a policy of negotiated transfer prices. There should be a policy of negotiated transfer prices. Negotiated transfer prices. Point number two, divisions should be encouraged. Divisions should be encouraged to buy internally first. To buy internally first. Buy internally first, where it will be in the interest of the company. Where it will be in the interest of the company. Yeah, so those are the two things that you can rotate around and discuss even more as issues pertaining to transfer pricing and issues that will help the company to maximize on profits. And the number one, we have said there should be the issue of negotiated transfer prices. That will ensure that everyone is comfortable with the price that we have settled for. And we will not have people complaining later, or people generating some bitterness, thinking that they were shortchanged, or thinking that the prices were set somewhere to their disadvantage. But when everyone has been given an opportunity to negotiate, no one should reasonably be expected to go complaining, because you had the chance to put across your case. Then we should also encourage internal purchases as much as possible. but not all the times. If we work out our costs and we check the external prices out there and find that doing it from inside is better, then we should encourage divisions to buy internally first. So those two things, you can be able to build on them and be able to argue your case. So with that, not unless there is a concern, I would wish to proceed to question number 4. Question number 4. Question number 4. Highlight 4 ethical standards of management accountants. 4 ethical standards of management accountants. That question, we came across it the other day. And I think I reminded you the 4 ethical standards. 4 ethical standards. So the question is coming from what we call ethical standards of management accountants. Ethical standards of management accountants. Ethical standards. Now, these ethical standards of management accountants, we know number 1 is called competence. Number 2 is called integrity. Number 3 is called confidentiality. And number 4 is called objectivity. It's called objectivity. So because these things are in your notes, I would want to leave them. You work out or you fill in some more information. They are in your notes. So let's not take a lot of time there. You can refer to your notes there. And if that is agreed, let us go to part B. Part B of the question says, BD Limited operates a single retail outlet with sales directed to the public. The profit statement for the months of March 2019 and April 2019 are provided as follows. So we have all that required. Using the high-roll points technique, identify the behavior of cost of sales, selling, distribution cost, and admin costs. So that question is coming from forecasting methods. Cost forecasting methods. Specifically, it is from NAIROBI. Specifically, it is from NAIROBI. Now, this NAIROBI, we know the format. Format is y is equals to a plus bx. That is the format. Y is equals to a plus bx. So let us start with the first one, with the cost of sales. Let us start with the cost of sales. Cost of sales. So with cost of sales, you can see in the month of March, cost of sales is 5,000, being equal to A plus, we are going to take the sales units, rather the sales in shillings, the way they have been given there. For the month of March, it is 8,000. So we will say 8,000 B. And then this other one, 5,500 is equals to A plus 9,000 B. So you solve here by subtracting. When you subtract, you are left with minus 500 being equal to minus 1,000 B. And from there, you tell us B is minus 500 divided by minus 1,000, and this is 0.5. And this one, or maybe before I talk of that, I will say 5,000 is equals to A plus 8,000 times 0.5. It will give me the value of A so that I see whether we are together. The value of A. Yes, Jabi. Yes, Dorcas. Diana, good. June. Amanda, Achie, good. 1,000. Thus, the fixed cost is shillings 1,000. Shillings 1,000. Variable costs is shillings 0.5 per unit of sales. Per unit of sales. Remember, we have used sales We have used sales as our units. Joseph, we are in question number 4. Question number 4 of May 2019. Question number 4 of May 2019. So that is for the cost of sales. Let us proceed to this other one called selling and distribution costs. Selling and distribution costs. So when you go to the selling and distribution, you can see we have 800 being equal to A plus 8,000 B. That is the value of the sales. Then 900 being equal to A plus 9,000 B. So this one, when you subtract, you have minus 100 being equal to minus 1,000 B. And therefore, B must be 0.1. B must be 0.1. So if I proceed and say 800 is equals to A plus 8,000 times 0.1, A is equals to what? Tell me A is equals to what? Yes, June, Diana, good. Amanda, good. Ivarine, Edwin, good. Jane, it is 0. Thus, fixed cost is 0. Variable costs is shillings 0.1 by unit of sales or per shilling. Say per unit or per shilling of sales, whichever. So the next one is what they are calling administrative costs. Administrative costs. Administrative costs, again, when we get there, we find it is 1,500 being equal to A plus 8,000 B. And then 1,500 A plus 9,000 B. So this one now, when you subtract, this is 0 and minus 1,000 B, and that tells you that B should be 0. B should be 0. Then proceeding and saying 1,500 is equals to A plus 8,000 times 0. That tells you that A should be equal to what? $1,500. Yes. We have 1,500. So that's fixed cost is shillings 1,500. Variable cost is 0. Variable cost is 0. The next part says draw a contribution break-even chart and identify the monthly break-even sales value and area of contribution. And assuming a margin of safety equal to that % of the break-even value, calculate BD's limited annual profit. Now, that one is no longer part of your syllabus. From 2015, in section 5, they don't examine candidates drawing graphs. So whoever brought this one there was by mistake. And what we do in such a case, the 4 marks and the 2 marks that follow are distributed up there. So Roman 1 in the marking center ended up with 12 marks, because it is not the problem of the candidate, but whoever set the exam did not confine themselves to what the syllabus says. And consequently, I will not take time to show you how to draw the break-even chart. Those ones are drawn in section 2. And the other issue, even if they were to be drawn, the guy who brought the question never included all the information. He left out the selling price. He left out the selling price or the units. One of the information should have been provided for us to do the break-even. But even if they were there, I would not have drawn, because they are no longer part of the syllabus. And that affects even Roman 4. That affects even Roman 4. It affects even Roman 4. So that question, we put it to rest at that point. Is that okay? Good. Let's proceed to question 5 now. Question 5. Global Chain Limited has supermarkets located in most towns and cities across the East African region. Over the last few years, profits have fallen, prompting the top management to seek technical advice from CP Limited, a consulting firm that specializes in business turnaround. CP Limited has managed to obtain relevant information from the management of the company and has organized it as follows. So we are given all that. We have the percentage of staff promoted, the average lead time, the sales turnover, the royal points, the number of staff grievances, the operating expenses, the customer satisfaction index, processing times. Now required, explaining using the current status of the global, prepare a balanced scorecard report covering the 4 perspectives using the information. So the question is coming from non-financial performance measurements. Specifically, the balanced scorecard. Balanced scorecard. The balanced scorecard. Now, as you know, and Mr. Karo, I know he has done a good job there. The balanced scorecard has 4 perspectives. It has 4 perspectives. So the first perspective that you know of, and the most popular, is the financial perspective. So we'll start with the first one, financial perspective. Financial perspective. Financial perspective. From your SG, this must be from SG, because myself, I never got into those details. But I know in SG you have done that. You are supposed to come up with the objective. You are supposed to come up with the objective. And then for each objective, you are supposed to tell us the initiative. The initiative. And then you tell us the measure. Then you tell us the target. You tell us the target. And then you tell us the appraisal, the conclusion. Those are the 5 things that should be there. For every perspective, you need to know what is the objective, what is the initiative, what is the measure, what is the target, and what is the appraisal. So here, the question or the examiner may not really have directed you on the objective, but going by your background of what financial perspective looks like, that it is more of the finances in the business, you are supposed to look at the information that has been given here. The information that has been given here, and try to come up with what could be the objective. Now, in the objective that I have come up with here, I am talking of growth of sales. If I want to check growth of sales, and this growth of sales, I will use, or the initiative here is not given. This one is not given. But what will I use? What will I use to measure growth? You can see there is sales stroke turnover. sales stroke turnover. Sales stroke turnover. That's the first thing. Then, when it comes to target, what are we targeting? We are targeting to move sales from 208 to 215. That is the target that you can see there. That is the target that you can see. Then when it comes to the appraisal, when it comes to the appraisal, you now make a comment based on the actual, whether our sales grew or did not grow. So you can see the actual moved from 200 to 192 to 169. So the comment you can say is that sales declined. Sales declined from 200 to 169. So that is the report that you can give, that sales declined. So sales declined. Now, for us in management accounting, we are so much focused on this, and this. We may not pay a lot of attention to this and this, but I'm not saying you should not know. That's why I've been taught in SG. But for us in management accounting, we want to know what is it that you're measuring. And actually, you don't even have to change the name. As I have changed here, you call it the growth of sales. You can just call it sales stroke turnover. That is the objective. Then you tell us, or you just make a comment. Have they increased or have they decreased? Are we doing better or are we not doing better? That would be good enough for us. That would be good enough for us. But because you have done SG, I want to just present it the way it should be perfectly presented. Now, the other thing that is financial, ukiangalia kwa hii information, is about the operating expenses. Operating expenses, they are about financials. So sasa hii, the growth, it is objective 1. Growth, we call it objective 1. So that now, ukishasema hivyo, we check the operating costs. We check the operating costs. So for the operating costs, we will call them objective 2 under finance. Under finance. And what maybe we'll be trying to do is managing operating costs. Managing operating costs. Managing operating costs. The initiative, why it is being done, we are not told, not given. The measure that we are going to use, this one, we will use the annual operating costs. The annual operating costs. That is what we shall use. Target, you can see it is given. Target is to reduce not to reduce, is to increase. A small increase. This one we can call it a small increase. From 180 to 185. So we just want to manage these costs. We are not seeking to reduce them, but we allow a small increase from 180 to 185. But what happens when you check the actuals? What report do you give? The actual is that you can see where we thought we would get 180 to 190. Instead of 182 tukakuwa na 196. Instead of 185 tukakuwa na 199. So we can say there was a significant increase from 190 to 199. So instead of the costs coming down, or rather increasing at a very small rate, they ended up increasing. So those are the two perspectives that would measure finance: the issue of sales and the issue of cost. Those are finances. Let us go to the second dimension. Let us go to the second dimension, which I want to call customer. I want us to start with customer dimension. So for customer dimension, tunaangalia in those points, the items that have been given, which one would focus on customer dimension? The first one is issues to do with royalty. You can see there is royalty points, and you can see customer satisfaction index. So that one has two objectives. So let's start with the first one, objective one. The royalties, you can see target is to maintain. Target is to maintain royalty points. Royalty points. Royalty points ni kama zile tunapeana kwa supermarkets, the card. Ama zile Safaricom wanaitaka Boga points and so on. So they want to maintain them at 1.5. So why are they doing this? Or what is the initiative? The initiative, or what they want to do, is awarding. Or how it will be done is awarding customer royalty points. That is how it will be done. They will award royalty points. And then what is the measure? How do we check? It is the royalty points awarded. Royalty points awarded. That is what we shall check. The royalty points that have been awarded. Then what is the target? The target is maintained at 1.5%. Maintain at 1.5%. And what now do we find when we check the appraisal? What is the actual? What we find is that the points declined. Points awarded declined. Points awarded declined. From 1.4% to 1.2%. So they gave fewer points to customers. They gave fewer points to customers. They gave to appoint to customers. Let's now look at the customer satisfaction index. Customer satisfaction index, and you can see the target is to maintain at 95%. So maintain at 95%. To maintain. The initiative, why or how it will be done, that one we are not told what they will do. But then what we shall check, that is the measure, is the customer satisfaction index. Satisfaction index. Customer satisfaction index. That is what we shall check. And what is the target? Maintain. The target is just like the objective. Although in the objective, we normally do not state the value. We don't normally state the value. But not much of a harm. Aya, sasa huyu mwingine the appraisal. Ukiangalia those points, or rather that index, it declined. It declined from 78% to 59%. We declined from 78 to 59. And maybe that's can be explained by the fact that we were able to see that the royalty points given to customers reduced. So these customers maybe waligundua na wakaanza kukasirika. That's why the index naona iko chini. So that shows that we are not doing so well as far as our customers are concerned. The next one is business process perspective. Business process perspective. So you look at those items that are given there and you identify which one will be pointing to business process. Business process is how things are done. How things are done in the organization. So sasa hapa, we can be able to see something like processing time. We can also be able to see the issues of read time. So let's start with read time. And what you can see, the target is to maintain read time. Maintain read time. That is objective 1. We want to maintain it at a stated point. From the time our customers make an order to the time we supply to them. Why or how is it going to be given? I mean, to be done. We are not told how they will do it. Now, what shall we check? What shall we check? What we shall check is the actual restocking days. Actual restocking days. Actual restocking days. That's what we shall check. or the restocking time. What is the target? Maintain at 3 days. Maintain at 3 days, that is the target. Then what happened? It prolonged from 3 to 4.1 days. It prolonged from 3 to 4.1 days. So customers now started experiencing delays. They started experiencing delays. Yeah. The next one that we can be able to check, number 2, is on processing time. So with this one, we will check, or we will seek to maintain processing time. Processing time. So with that, why or how will it be done? It's not given. So what we shall check? Replacement period. Replacement period. Replacement or the period of the warranties. And the target is maintain at 1 week. Maintain at 1 week. You maintain at 1 week. So what is the appraisal? It prolonged. It prolonged from 1 week, actually 2 weeks, to 3 weeks. It prolonged okay. Then finally, let us look at the one for running and growth. So running perspective. So this one, so here again we have 2 of them. We have 2 of them. The first one is the promotion. And you can see is promote. The objective is to promote 30%. That's the objective. So reason not given. We are not told why. So what are we going to measure? Actual promotions. That's what we are going to look at. Actual promotions. When we look at the target is maintained at 30%. At 30%. Maintain at 30%. So what happened? It was way below 30%. I can only say way below. Because you can see they had 6%, 5%, 8%. It's very poor. It's way below the target. It's way below the target. A book comment the same on your own with staff grievances. Do the same with grievances. Grievances. Do the same. Grievances. Okay, if you are finished, Adika finished, so that we proceed. You are finished writing the one for grievances. Have you finished? Yes, Joseph finished. Yeah, good, good. I can see we have finished. June, is that message mine? June, are you writing to someone who is asking the question? So part B now, Hazina Limited is, okay, Vati, I can see good. Hazina Limited is a cosmetics company that produces perfumes. The perfume market is very competitive and subject to frequent changes. The finance team at Hazina Limited, just a minute. Prepare monthly rolling budgets. Prepare monthly rolling budgets as part of their planning and management control process. The data for the forthcoming new budget period are as follows. The variable cost of producing a bottle of perfume is $210. The planned selling price of a bottle of perfume is $450. And at this selling price, demand for the perfume is expected to be 125,000 bottles. Information from the marketing division at Hazina Limited suggests that for every shilling 30 increase in the selling price, the customer demand would reduce by 10,000 bottles, and that for every shilling 30 decrease in the selling price, the customer demand would increase by 10,000 bottles. Required. Advice on the revenue that Hazina Limited would earn if the selling price of a bottle of perfume was set in such a way that profits would be maximized for the forthcoming budget period, and explain the use of rolling budgets in planning and management control process at Hazina Limited. McKenna, you're asking, what is the measure of grievances? The measure of grievances, you would say grievances roached. Grievances roached. How many people, how many staff have complained? That would be the measure. The grievances roached. Hizo unaona hapo kina 47, 101, 123. The grievances roached. The target was to have no grievances, which is not realistic. That is not realistic. Everywhere, every time, people must complain. So what we try to do is to minimize the complaints. But now what you can see here, this company, their complaints or their grievances increased from 47 to 123. So they were not doing so well. Maybe the managers were partial. So McKenna, I hope that is okay. June, hope that is also okay. Good. So hiyo ingine nimesoma is coming from pricing methods. Pricing methods. And what we call microeconomic. So under microeconomic, we say that P is equals to A minus BQ. We are told at a price of 450. At a price of 450, demand is equal to 125,000. But if you change the price by that bob, tuseme upunguze ikuwe 420, demand would increase by 10,000. So itakuwa 135,000. So solve that and give me the value of A and B. Solve that quickly and give me the value of A and B. What are the values? B, what do you have for B? .003, and then ukuja hapa useme 450. Yeah, Edwin, good, and B. So useme A minus 125,000 times 0.003. So based on that, so if I say times 125,000 equals, then it's 450 plus the answer 825. Good. When B, I can see that 825. Thus, price is equal to 825 minus 0.003 Q. So from there, utasonga useme revenue will be 825 minus 0.003 Q. You multiply by Q. That will be the revenue. So my revenue will be 825 Q minus 0.003 Q squared. Then from there you proceed and tell us for maximum profits. For maximum profits, marginal revenue should be equal to marginal cost, which is the same thing as variable costs. Marginal revenue should be equal to marginal costs, which is equal to variable costs. So with that now, that is marginal revenue, this one, it will be 825 minus 0.006 Q. Marginal cost, which is the same thing as variable cost, we are told it is 210. Thus, 825 minus 0.006 Q is equal to 210. Solve that and give me the value of Q. Yes, June, 102,500. Hence, revenue should be equal to 102. Revenue should be equal to, ukuja hapa kwa hii function 825 times 102,500 minus 0.003 times 102,500 squared. So you substitute that 102 to this revenue function. You mean the revenue? Yes, I can see 53 million, 043,750. 53,043,750. Okay, the next bit is on the topic of budgeting. Is the topic of budgeting, and specifically what we call rolling budgets. And I told you these are budgets that roll. These are budgets that roll. So how will they be rolling? Also now this will explain the use of rolling budgets or how they can be used. So point number one, the company should start by preparing an annual budget. Point number two is that the annual budget should be updated. Every month. Should be updated every month. That is what I told you is called a sub-period. It's called sub-periods. And now, this or these adjustments or these updates will capture the frequent changes. The frequent changes the frequent changes in the perfumes. They are calling it perfumes, eh? In the perfumes market. As you can see, we are told the environment is very competitive and has frequent changes. And the end result is better decisions. Better decisions and enhanced value. And enhanced value. So when you are able to capture those changes, then you are in a position to make very good decisions, and the value, the profits, the organization increase. The profits of the organization, they increase. So I think I'm okay with that, or we should be okay. I have 8 minutes. So before I run away, maybe we could handle the theory for part 1. Stating 2 examples in each case, distinguish between internalized environmental cost and externalized. Let's handle that quickly. So that one has come from what we have been calling environmental management accounting. Management accounting. Environmental management accounting. Internalized costs. Environmental costs. Internalized environmental costs. And we say these are costs which directly impact on the income statement. The income statement. They can be seen directly. They affect our income statement. Some examples. Examples 1, you can talk of waste disposal costs. Waste disposal costs. When you pay for the garbage collector, that is a cost, that is an expense that number 2, licenses fee. When you pay for the licenses, to obtain that, there is what we call product take back costs. Take back costs. Now, product take back cost, if you look at some of these like bottles, like bottles. I was looking for whether I have one, and I don't. Ama hizi makaratasi kama za mikate. Utaona kuna kakitu wanakuaga wamechora hapo, a dustbin. Wanasema take me back to the shop. So the idea is the customer ukishamaliza kutumia mkate, hiyo karatasi badala ya kuweka kwa dustbin yako urudishe kwa mwenye duka. Naye mwenye duka arudishie mwenye alitengeneza hiyo mkate, alipackage. Then from there now they can either recycle or they can dispose in a good way. That's what we call the take back. But unfortunately in our Kenyan system that has not seen the light of the day, but is part of another one is back-end costs. Back-end costs. Now, back-end costs, these are costs you incur when you complete the project. Like maybe ni nyumba ulikuwa unajenga, uenda kutupa hizo matakataka, hizo zimebaki huko, those kind of things, and so on. Then from there, let me mention kidogo about externalized costs. Externalized costs. Externalized costs. Externalized costs. These are costs. These are costs whose effect is on the society. Is on the society. So it's not the company that will feel the impact directly or immediately, although later on they will still catch up with the company. But at the beginning, it is the society that will feel that. And we can talk of some examples. Some examples of this. Some examples. One is carbon emissions. Carbon emissions. When we emit, zikishatoka huko juu, the company does not feel it. In any case, imeenda huko nje. So it's the society to feel it. Number two, we have issues of forest degradation. Forest degradation. When we destroy our forests, you as a company, you don't feel the impact immediately. But later on, you will come to feel that. The other one is issues to do with healthcare. There is the issue of healthcare. Healthcare costs. This is where once the company has done the emissions, the workers inside hawagojeki, but hizo emissions imeenda huko nje where the relatives of these workers are. So watu wao wataanza kugojeka. Wakishagojeka, maybe your workers, you have given them some medical cover. So your card, ndio wataenda watumie hospitali to provide medical care for their people. And closely related to that, you will have what we call the welfare costs. Welfare costs. Utaanza kuitwa harambee za magonjwa, hospital bills, mazishi, those kind of things, accidents, shortages of water. Actually, we should also put about water, use of water and energy. Wewe ukitumia maji and energy and power, you don't feel it, but finally it comes back to you in the name of your workers. Even if your workers are safe, their relatives will be unwell. And you can be sure, even a person like me, I cannot make noise the way I'm making right now if my people are not well. If there is a problem in my house, you realize I will also be affected. So in as much as my family and my children do not work in Destiny, if they have an issue, then Destiny will also feel the impact. So those are the things that we're saying we need to be mindful about. And with that, we can call it a lesson and hope to meet in the next lesson, God willing. Thank you so much. Have a nice evening.